Why do traders care so much about certain price areas on a chart? Because price often slows down, reverses, or accelerates around levels where buyers and sellers have reacted before. That is the basic idea behind support and resistance. Support is an area where buying interest may appear and slow a decline. Resistance is an area where selling interest may appear and slow an advance. The key word is area. In real markets, these are usually zones, not perfect lines. Price does not stop obeying all uncertainty just because it reaches a level on a chart. So why can these zones matter at all? Reason is memory in the market. If price turned higher from a certain area before, some traders may notice that and watch it again. If price repeatedly struggled to rise above a certain area, traders may treat that as resistance. The more often market participants focus on the same zones, the more those zones can influence behavior. That does not make them certain. It just makes them relevant. Support and resistance are commonly identified in a few simple ways. First, traders look for prior reactions. If price fell into an area and then bounced, that area may be marked as possible support. If price rose into an area and then pulled back, that may be possible resistance. Second, traders look for repeated tests. A test means price comes back to the same area again. Multiple reactions near a similar level can make that zone more noticeable. Still, repeated testing does not guarantee the level will continue to hold. In some cases, many tests can weaken a level because buyers or sellers at that area may gradually get absorbed. Third, traders look at broader market structure. Market structure means the overall pattern of highs, lows, trends, and ranges. In an uptrend, prior pullback areas may be watched as support. In a downtrend, prior rally areas may be watched as resistance. In a sideways range, traders may focus more on the upper and lower boundaries of that range. Now let's turn this into a decision framework. Traders often use support and resistance to answer three practical questions. Where might I consider acting? Where would the idea look wrong? And where might I reduce or exit exposure? In other words, entries, risk, and exits. For entry planning, one approach is to look for a reaction at support or resistance. For example, a trader watching possible support may wait to see whether price stabilizes there instead of buying simply because price touched the zone. That is where confirmation comes in. Confirmation means waiting for some additional evidence, such as price rejecting the level, closing back above a support zone, or forming a higher low, which is a low that stays above the prior low. Different traders define confirmation differently. Another approach is breakout trading. A breakout is when price moves through a support or resistance zone with enough strength that traders believe the market may be entering a new phase. Some traders wait for price to break above resistance before considering a bullish setup. Others wait for price to break below support before considering a bearish setup. But breakouts can fail. Price may push through a level briefly and then reverse back into the prior range. That is often called a false breakout or failed breakout. Here is a hypothetical example. Imagine an asset has pulled back several times to roughly the same lower area and bounced. A trader marks that zone as possible support. If price returns there again, the trader has choices. One trader may act immediately at the zone, accepting more uncertainty in exchange for an earlier entry. Another may wait for confirmation, such as a clear bounce or a close back upward, accepting a later entry in exchange for more evidence. A third trader may do nothing unless price breaks below support, and then retests that area from underneath, treating the old support as possible new resistance. None of these responses is automatically correct. They are different ways of balancing timing, evidence, and risk. That leads to an important comparison. Support and resistance is not the only way traders analyze charts. Some rely more on trend-following tools, moving averages, indicators, volume analysis, or patterns. Support and resistance can be used alone, but many traders combine it with other methods to avoid treating a single line as a complete strategy. For example, a level may matter more to a trader if it aligns with the broader trend or with a recent price pattern. But even then, interpretation varies. What looks important on one time frame may look minor on another. A day trader and a long-term investor may mark very different levels on the same chart. There are also clear limitations. First, levels are approximate. Markets can overshoot support, reverse before touching resistance, or trade noisily around both. Second, reactions can be temporary. A bounce from support does not prove a lasting reversal. A break above resistance does not prove continued upside. Third, different traders can draw different zones from the same chart. There is judgment involved. Fourth, Market behavior depends on context, and that context can change. No support or resistance method works universally across all assets, timeframes, or market conditions. So what is the practical takeaway? Think of support and resistance as a framework, not a promise. These zones help traders organize what they are seeing on a chart and define possible action points, possible invalidation points, and possible exit areas. Used carefully, they can support a disciplined process. Used carelessly, they can create false confidence. If you are learning this concept, practice marking zones based on prior reactions, repeated tests, and overall structure. Then ask, what would count as confirmation? What would make this idea wrong? And how would uncertainty affect the plan? That mindset is often more useful than trying to predict exactly what price will do next.